Most people think banks simply store their money safely. But in reality, that's not what really happens. When you deposit money into a bank, it doesn't just sit there waiting for you. The bank actually uses that money to make more money. Here's how it works. Banks take the money people deposit and lend it to others in the form of loans. This could be for buying a house, a car, or even using a credit card. But when banks lend money, they charge interest. For example, if someone takes a loan, they don't just pay back the amount they borrowed, they pay extra. That extra amount is called interest. And this is where banks make a large part of their profit. At the same time, banks may pay you a small amount of interest for keeping your money with them. But here's the key difference. The interest they pay you is usually much lower than the interest they charge borrowers. That gap between what they earn and what they pay is profit. But that's not the only way banks make money. Banks also earn through fees. This includes things like account maintenance fees, ATM charges, overdraft fees, and transaction fees. These small amounts may not seem like much, but across millions of customers, they add up quickly. Banks also invest money. They use funds to invest in financial markets, government bonds, and other opportunities to generate additional income. So even though it feels like your money is just sitting safely in a bank, it's actually part of a much larger system. A system where your money is constantly being used, moved, and multiplied.